Ankita has a question. She says, we have a car loan at 1.74% from 65 months, or for 65 months. Since it's out of the 23-8 car buying rule, should we consider it as high interest debt and clear it out ASAP? We would need to reduce Roth IRA contributions. How should they handle this?
Man.
Dun, dun, dun. I should have put my little disclaimer. Guys, this is a spicy one.
Why is the whole content team cracking up right now? They knew where this was going to. All right, let me start it. I'll start it. Can I start it?
Yeah.
Here's what you got 1.7% for a 65-month loan. Before we talk about whether that is high interest debt or low interest debt, you are in a situation where you are outside the realm of affordability, right? Like you're outside the realm of what you should be doing. So immediately, one of the things that I would think through is I got to figure out, how do I get back to 3 years? How do I get back to 36 months? So I would refigure my math. I know what my minimum payment is based on how long I financed. And if it's 65 months, I'm guessing that means she did a 72-month loan. Probably going to be what she did. I got to reconfigure how much payment would I need to pay to make it fall inside of 23.8. And I would reconfigure that to figure out what would my monthly payment be. Well, then I would think, holy cow, if I've got that monthly payment, does that now go over the 8% of monthly gross income that I could be paying on this car? And if the answer to that is yes, I think you got to make some really hard car decisions. Now, I'm hoping the answer to that's no, and you can reconfigure it, have it on the 23.8, and then you can make the assessment. Does 1.7 fall into high interest debt, or does it fall into low interest debt? But I think at the very minimum, you got to get on the 36-year amortization, 36-month amortization.
Thank you for the time, because it allowed me to clarify, and we're going to sync up so well. This is perfect. Here's the first thing. Reliable transportation is important, but if you tell me you bought it, you already broke 23.8 when you did a 72-month loan, I'll just go ahead and tell you, in financial priorities, Roth IRA is way on up there. I mean, it's a big one. Tax-free growth. There's a reason the government restricts who can put money in, how much you can put in, because they know, man, we are giving them one heck of a deal when we set up these Roth IRA accounts. So it is priority. Super high, numero uno. It's very important, especially in your situation. So here's what I'm going to do. It's going to tie into what Bo's saying. I'm giving you don't shut down the Roth IRA. Don't shut it down. But I'm giving you a 12-month grace period with this 1.7% period where you're still going to be funding in your Roth IRA. But I'm giving you 12 months to figure out how you're catching this thing to the back to 36 months, because that's what I have clients all the time when we get into these strategies where they're higher income or they have something where they're trying to figure out from a tax perspective. It's just so powerful we can't walk away from either the tax deduction or the tax-free growth opportunity. So I say, well, let's squeeze the cash flow. You have to get very serious so that by April 15th, we have this amount of money sitting in the account to cover it. I know it's a little different than her situation, but it is one of those things where do the Roth, but in the background, I want you trying to pull other levers to figure out how do I get this, accelerate my payments on the car loan. And if you can't do it, it's back to, if you say, if you get to the end of 2023 and you go, man, there is just no way I can get this thing paid off within the 36 months. Then I think you have to make a hard decision. I think you might need to get rid of the vehicle. I know you're probably thinking I have an arbitrage situation because interest rates on car loans are around 6% and I have a 1.7%. But man, if you did this only because the salesman allowed you to take you could afford this size purchase, but you doubled it up by going out longer on the amortization, that's where the mistake was made. But I'm going to give you a little bit of grace to see if you can dig yourself out of this, but you don't stop the Roth IRA, because the biggest thing that makes me sad, and I've shared this story a number of times, is like I had an attorney friend in their early 20s. Now they're extremely successful, but they were paying off some of these low interest debts and other things before they were funding their Roth IRA because they had listened to somebody else say it. And I was like, what do you do? I was like, you realize at the rate your income is going up that you will not be able to fund Roth IRAs anymore, yet you're going to have paid down this interest rate. That's why I'm giving you this 12-month grace period, is because you might be in a situation, maybe you're going to have a pay raise coming up, maybe there's a year-end bonus that's coming your way. there's a chance you're going to be able to dig yourself out. I just don't want you to walk away from that awesomeness of the tax-free Armageddon growth opportunity of Roth IRAs and health savings accounts. Make sure you respect that. It's a reason that beyond the free money of your employer, the next stop on investments that we have in the financial order of operations is step 5, which is that Roth and health savings account and all the tax-free favored growth opportunities.